Are you considering to lend money to someone? In today's video, I'm sharing with you the 3 factors that you need to take into consideration in order to be able to evaluate your risks. Hello and welcome. My name is Peter B. and I welcome you here at My First Million, where we are achieving our financial goals together. So in today's video, we are taking a look at the 3 essential factors, the 3 areas that we need to take a look into in order to properly evaluate if it's too risky or not to lend money to someone else. For this, let me move to my whiteboard. So the first area, the first factor you want to take a look into is what is the debt used for? So, or in other words, is what the person you're lending the money to, is he putting the money into something that is able to keep its value or even generate a return? If yes, then the less risky the investment is going to be. And I put here some examples, and the lower down the examples, the less risky they are. The most risky is potentially consumer debts here in the example, because consumer debts are usually used just to spend money on something that you will be used and that often just loses its value, or it will lose its value very soon. So you won't be able to recover anything from the thing that the borrower has purchased from. Then similar to consumer debts is maybe a car loan. If the money is used to purchase a car, as we all know, a car is losing his value very fast. It's a very fast depreciation happening if you are driving a car, especially if it's a new car. Then a third one would be like an owner-occupied mortgage. So if someone is using the money to, for instance, buy an apartment or a house, this investment will not generate a return, but at least it should be able to keep its value, or more or less be able to keep its value, unless we are just at the peak of a market cycle of the real estate market. And the fourth example would be a mortgage on a rental property. In this case, it's likely that the thing for what the money is used for can be able to keep its value and even will be generating a return for the person who borrowed the money from you. So this is the first area of risk. Then to the second area of risk is the borrower himself. Basically, is the borrower able to pay the interest and repay the debt at the end of the contract? And for this, you want to cover the following areas. You want to know what's the income of the borrower. Does he has a steady income, a stable income that he can be using for the interest payments and also to pay you back later? Does he has any assets, not just what he's using the money for, but maybe but also other assets that he owns? Maybe he's using the money for buying a car. However, maybe he already has a full paid for house that he can give you as an assurance that is also stabilizing his situation. Then you also want to know his debt situation. Is the debt that the money that you are giving him the only debt that he has, or does he has other debt from other people or companies or from banks? So you want to know this as well. And you want to also know other assurances. So if you feel like the first 3 areas is very risky, doesn't have a stable income, no assets, and maybe a lot of other debts, then what it also can help that maybe someone is supporting this person as a co-signer, for instance. So if he will not be able to repay you the debt, the other person then as a co-signer need to jump in and help to repay the debt. So then of course you also need to evaluate the co-signer's financial situation. So the borrower is the second area that you want to take into consideration. Then the third area is the terms of the contract. What are the details in the contract that you agree on to lend the money to this person? And these are the areas how you personally can manage your risk better. So for instance, you can play with the duration. The longer the contract duration is, the more risk is that something happens to the borrower over time that he might not be able to repay. So if it's a shorter duration, the less risky. The longer duration it is, the more risky it will be for you. Then of course the interest rate. The more risky of an investment you evaluate, the more return you want to see, so that you will be able to profit more in order to the risk that you are taking. Then also maybe you can consider some collateral into the contract. For instance, if he owns a house or if he owns a car or maybe something else valuable, you can use this as a collateral. So in terms that he's not able to pay you the interest or the debt back, the loan back, then you can use the collateral to get at least part of your money back. And of course, but if using a collateral, you want to make sure that the collateral is not used for covering other debts as well. So these are the three areas. Then in the end, if you're lending money to someone, you want to take the magic triangle of investing into consideration. I've covered this in a previous video. So basically, you want to balance out return, risks, and liquidity, the triangle here. So if in this situation, the higher the risks is, you want to make sure that you will also receive higher returns, or you want to make sure that the liquidity is also higher so that you get the money back faster. So the higher the risk, you either want to make sure that you get a higher return or that you get the money back faster, or even both, ideally even both. So in the magic triangle, the three areas are balancing out one another. And of course, the lower the risk is, the less return you need, or maybe the longer you can wait until you get the money back. Do you have any experiences of lending money to someone? And if so, what were your experiences? What worked well and maybe what didn't work so well? Please share your experiences with us so that we can learn from one another. Please share them in the comments below. Thanks a lot for joining me today. I look forward to see you in the next video, and especially I look forward to see you winning financially.